Assalamualaikum. My name is Katrin Nadia Shadia and my matrix number is F1057. Me and my partner will present about topic 3, the concept and practice of investment and financial decision making. Me and my partner choosing a concrete engineering product Berhad, and I will be covering the detailed financial ratio analysis for the year 2024. To ensure our analysis is accurate and useful for financial decision making, I have categorized the ratios into 4 case areas, which is liquidity, efficiency, leverage, and profitability. These figures are derived directly from the 2024 Statement of Financial Position and Statement of Profit or Loss. First, let's look at liquidity, which measures the company's ability to pay off its short-term debt. For 2024, a current ratio resulted in 0.71 times. This is calculated by dividing current assets by current liabilities. A ratio below 1.0 suggests that for every 1 ringgit of debt due within a year, the company only had 71 cents in liquid assets. Next, a quick ratio. When we remove inventory from the equation to see the most liquid assets, the ratio drops to 0.18 times. This tells us that in 2024, Capco was heavily reliant on selling its inventory to meet its immediate financial obligations, indicating a tight cash flow positions. Next, we move to efficiency ratios. We show how well the company uses its asset to generate revenue. Inventory turnover. In 2024, this was 2.27 times. This means the company clear and replace its stock roughly twice a year. Next, average collection period. One of the stronger points in 2024 was the collection speed. It took the company an average of 28 days to collect payment from credit customer. As we will see later in our group comparison, this was much more efficient than the following year. Next, fixed asset turnover was 1.31 times and total asset turnover was 0.82 times. Meaning for every ringgit invested in assets, the company generated 82 cents in sales. This shows how hard the company total investment was working to produce top-line growth. Now, let's discuss leverage or how much the company relies on borrowed money. In debt ratio, in 2024, the ratio was 53.16%. This means more than half of Capco's assets were funded by creditors rather than shareholders. Debt to equity. This set at 113.5%, indicating that debt exceeded the total equity of the company. Time interest earned. Despite the high debt, the company had a ratio of 8.08 times. This is an important figure because it proves that even though 2024 was a difficult year, the company still generated enough operating profit to cover its interest expenses 8 times over. Finally, we look at profitability, which evaluates how efficiently the company generates earnings relative to its sales and assets. The gross profit margin. The company maintained a margin of 23.17%. This indicates that for every 1 ringgit of sales, the company kept about 23 cents after paying for the direct cost of production. Now, we look at the operational profit margin, which was 113.5%. The ratio is unique because it measures the efficiency of the company's core business operations before the impact of taxes and interest. Even though the company faced an overall net loss, this positive operational margin shows that the core business activities themselves were still generating a surplus. However, once we account for all other expenses including interest and taxes, net profit margin fell to negative 4.5 -4.45%. This tells us that the non-operating costs were a significant burden on the company's bottom line in 2024. Another critical metric is the return on assets, which was negative 3.65%. It shows how efficiently management uses the company's asset to generate profit. A negative ROA in 2024 indicates that for every ringgit invested in machinery, land, and inventory, the company was actually losing about 3.6 cents. Finally, the return on equity was negative 7.79%. This is calculated by dividing the net profit by the common equity. This negative result shows that the shareholders' investment did not yield a profit during this fiscal year. In summary, 2024 was a year of operational resilience, but overall financial challenge for Capco. While they managed to stay operationally positive, the total asset utilization and net profitability were under significant pressure, setting the stage for strategic changes we see in 2025.
Hi, my name is Jambrika Dr. Joginder Singh. My metric number is F1060. I would like to present about Concrete Engineering Product Berhad Company for 2025. First of all, I will explain the liquidity ratio for 2025, which measure the company's ability to meet its short-term obligation. First is current ratio, which compares current asset divided with current liability. We get total is 0.99 times. Compared to 2024, we only get 0.71 times. So current ratio for 2025 is higher. For quick ratio, current assets takeaway inventory takeaway pre-expenses divide with current liability. At here we can see for concrete engineering product Berhad, we doesn't have pre-expenses. So we only divide take away with current assets and inventory and divide with current liability, which we get 0.59 compared to 2024 we get 0.18 times. So 2025 is higher. The current ratio includes inventory and focuses on more liquid assets. It provides stricter measures of liquidity. A lower quick ratio suggests the company may face difficulty paying immediate obligations. Overall, the liquidity position in 2005 is stronger depending on whether the ratio improved compared to 2024. So basically, the 2024 liquidity ratio is higher than 2024. So it is strong enough for it. Next, efficiency ratio. Measure how effectively the company uses its assets and manage operation. As we can see, average collection period. This show how long customer take time to pay back. A shorter period indicates faster collection and better cash flow. As we can see for 2025, the average collection period is 149 days. Compared to 2024, it is 28 days. So which means 2024 average collection period is much better than 2025. Next is inventory turnover. This measures how quickly inventory is sold. A higher turnover indicates efficient inventory management. As we can see, inventory turnover for 2025 is 1.70 times. Compared to 2024 is 2.27 times. So which is much better is 2025 lah. It sold faster. The third one is fixed asset turnover, which shows how effectively the company uses its fixed asset to generate sales, which for 2025 is 0.67 times compared to 2024 is 1.31 times. The last one is total asset turnover. Measure how effectively total assets are used to generate revenue, which is for 2025 is 0.40 times compared to 2024 is 0.82 times. Overall, the efficiency of the company in 2025 is improving based on how well it managed its resources. However, leverage ratio for debt ratio is 41.1 per 5. Debt to equity is 0.70% for 2025. The last one for the leverage ratio is time interest earned. The measure the company's abilities to pay interest expenses. A higher ratio indicates better financial stabilities. For 2025, time interest earned is 66 times. Compared to 2024, it's only 8.08 times, which is 2025 one is much better than 2024. Last but not least, finally, profitability ratio measure the company's ability to generate profit. For 2025, gross profit margin is 0.31 compared to 2024 is 23.17%. This shows profit after deducting cost of goods sold. A higher margin indicate better cost control. Second is operational profit margin, which is reflect profit from core business operation before interest and tax. For 2025, it is 0.60% compared to 2024 is 13.11%. The third one is net profit margin. We show the final profit after all expenses. It indicates after overall profitability. For 2025, it is 0.33% compared to 2024 is negative 4.45%. Next is return on investment. Return on investment measure how effectively the company uses its investment to generate profit. For 2025, it collect 0.13% compared to 2004 is negative 3.65%. The last for profitability ratio is return on equity ROE, which shows how much profits is generated from shareholders fund. For 2025 is 0.20 0.22% compared to 2024 is negative 7.79%. Overall, the profitability in 2025 is improving depending on company's performance.
Moving on to our analysis of Catco's financial performance between 2024 and 2025. First, liquidity. We observe a positive trend in liquidity. The current ratio improved from 0.71 times in 2024 to 0.99 times in 2025. This indicates the company is now better positioned to cover its short-term debts. However, efficiency is a concern. The average collection period spiked from 28 days to 149 days. This means the company is struggling to collect payment from customers. Inventory turnover also slowed down from 2.27 times to 1.70 times. Next, leverage. On a brighter note, leverage has improved. The debt ratio decreased from 53.16% to 41.15%. Most impressively, the term interest earn ratio jumped to 66 times, showing a very strong ability to pay off interest expenses. And profitability, the company successful return to a profit, although the net profit margin is small at 0.33%. A significant recovery from the negative 4.45% loss recorded in 2024.
Therefore, I'm going to talk about based on the financial analysis for 2025, several recommendations can be made to improve the company's performance. First is tighten credit control. Management should tighten credit control. The company has a high average collection period of 148.7 days, which means customers are taking too long to pay. This can affect cash flow and liquidity. Therefore, stricter credit policies and offering cash discount for early payment can help speed up collections. Second, improve inventory management. The company should improve inventory management. The declining inventory turnover indicates that stock is moving slowly. The impact of it this may lead to excess inventory and higher storage cost. To suggest the solution is management should optimize stock levels and identify slow moving items to avoid typing up capital unnecessarily. Third one is cost optimization. Cost optimization is very important. Although the company has returned to profitability, the profit margin are still low. This means the company is not efficiently controlling its cost. Management should review the cost of sales and administrative expenses to improve overall profitability. Last but not least, maintain debt strategy. The company should maintain its current debt strategy. The lower leverage ratio show reduce financial risk. The impact is this improve financial stability and reduce dependence on debt. So the conclusion is By improving credit contract, managing inventory efficiently, optimizing costs, and maintaining a strong debt strategy, the company can strengthen its financial performance in the future. Thank you.